Good morning everyone, and welcome to today's market analysis. The global markets are currently displaying a significant divergence. On one hand, we're witnessing the robust performance of technology stocks, which have propelled the Nasdaq index to a new historic closing high of 26,247.08 points. Sentiment in specific sectors remains exceptionally optimistic. On the other hand, while the VIX Volatility Index, a gauge of market fear, holds at a moderate 17.19, U.S. consumer confidence has plummeted to an all-time low. This clearly indicates a coexistence of a strong tech-driven narrative with underlying soft macroeconomic expectations. Our primary direction for today is to advocate for controlled long positions in technology growth stocks, a strategy we believe carries a success probability of around 70%. The main axis of capital flow remains highly concentrated in artificial intelligence, or AI, and the memory chip sectors. Looking at the global capital flow path, we anticipate a continuation of the trend from Asia to Europe and then into the US pre-market, with a 70% probability. The strong close for US tech stocks, particularly the Nasdaq's outstanding performance, is expected to have a positive spillover effect on related sectors in Asia and Europe. However, we must remain vigilant regarding geopolitical risks in the Middle East, which could trigger risk-off sentiment and disrupt capital flows. We assign a 30% probability to such a disruption. Let's now break down the macroeconomic drivers. On the interest rate front, the situation is currently neutral. The 10-year U.S. Treasury yield has stabilized at 4.36%. Following the April non-farm payroll data, market expectations for the Federal Reserve to maintain rates have largely been digested, reducing the marginal impact of interest rates on the market in the short term. The US dollar index, DXY, has weakened to 97.84, while the offshore yuan, USD/CNH, has strengthened past the 6.8 mark. This is a moderately bullish signal for non-dollar assets, alleviating exchange rate pressure and supporting global risk assets. However, inflation pressure remains a significant bearish factor, with an 80% probability. WTI crude oil prices are high at $95.42 per barrel, and coupled with U.S. consumer anxiety stemming from rising oil prices and tariffs, this will continue to exert pressure on corporate costs and consumer purchasing power. Furthermore, geopolitical risk is another undeniable bearish factor, with a 75% probability. The sporadic conflicts in the Middle East have kept Brent crude oil prices elevated at $101.29 per barrel. Any escalation in conflict could swiftly push the VIX index higher, impacting risk assets. Turning to core asset performance, the general direction for U.S. equities is upward, with a 75% probability. The supporting logic primarily comes from optimistic sentiment in the AI sector and strong earnings reports from leading companies. However, elevated inflation expectations and subdued consumer confidence are potential drags. The A-share market is currently dominated by domestic capital, with sentiment judged as moderately optimistic. Despite major indices, such as the Shenzhen Component Index, closing down 0.5%, more individual stocks rose than fell, and structural hotspots like commercial aerospace and humanoid robots showed active trading, indicating that domestic capital is actively seeking new breakthroughs. Bitcoin, as a signal of risk appetite, is currently confirming a risk-on environment. Its price has solidified above $80,913.80, with Ethereum also seeing concurrent gains to $2,327.85, both confirming that market preference for higher risk assets persists. In commodities, gold prices are high at $4,730.70 per ounce, and oil prices are also elevated, reflecting a dual premium from geopolitical risk and inflation expectations. Regarding the main capital themes, the first remains AI and memory chips. The direction is upward, with an 85% probability and strong continuity. The Philadelphia Semiconductor Index surged 5.51% last Friday, and leading stocks like Nvidia, trading at $215.20, showed strong performance. This indicates that smart money is continuously and concentratedly flowing into this sector, betting on its long-term growth certainty. The second theme is inflation and geopolitical hedging, with a trending strong bias and a 70% probability. WTI crude oil prices and gold prices are driven by the Middle East situation. This theme will serve as a direct reflection of market risk aversion, with trading activity dependent on news developments. Looking ahead, we predict that the Nasdaq index will attempt to reach 26,500 points in the coming week, continuing to outperform the S&P 500. This week, the A-share market structural differentiation is expected to intensify, with AI-related individual stocks on the STAR market likely to show significant outperformance. Bitcoin's price is projected to remain above $80,000 over the next 72 hours. And WTI crude oil prices are expected to stay above $92 per barrel this week, unless a substantive peace agreement is reached in the Middle East. In summary, the market is currently balancing between technological innovation and macroeconomic headwinds. Tech growth stocks remain the primary focus for capital, but geopolitical and inflation risks require heightened vigilance. We advise investors, while managing risk, to seize structural opportunities, focusing on the AI and semiconductor sectors, and simultaneously hedging against potential macroeconomic uncertainties.